Hey, good morning, everyone. Marty Missouri here. It's the 16th of March, 2024, with your weekly economic update. Clients, this will come to you connected to an email as Monday morning's message. Going to just run through some inputs to our index. We have 47 inputs to what we call our PWA index. It's one of our tools that gives us a feel for overall general conditions. I do want to circle back on the stock market. The last update I gave you, I recorded Thursday morning, sent it out to you clients on Friday, and I want to show you what has developed on the technical setup. I'll do that real quickly on stocks as well. And then just want to look at what I'll call our recession call. The way I like to say it is that our recession light is lit, how long it's been there, what it portends, that sort of thing. So first up, our PWA index actually ticked up 4 points week over week from a minus 23 to a minus 19. I'll show you charts on the two areas that actually improved week over week. Everything else pretty much stayed as is. Right now, 21% of our inputs score positive, 41 negative, 38% score neutral. So we'll start with retail sales. They were released last week, and they didn't improve nearly as much as analysts had anticipated coming off of what was really harsh weather in February. Initial jobless claims actually were amazing, still 209,000. And I've been talking about how stubborn the continuing claims have been, but they actually came down by like 100,000. However, this particular report was influenced by the once per year seasonal adjustment factor by the Department of Labor. So this one we definitely want to take, I guess, with a grain of salt, so to speak. Small business optimism continues to roll over. The overall optimism index dropped to 89.4. It was at 89.9 last month, nearing the lowest levels since all the way back to 2013. The 50-year average is way back up here at 98. So small businesses certainly aren't feeling it still. And you can see hiring plans continue to roll over, as do capital expenditure plans. So not a good look in terms of how small business owners, which employ like 60% of Americans, feel about the current state of economic affairs. Now, what did pop much higher was heavy truck sales. So that got upgraded from neutral to positive in our index. And Cass freight shipments picked up nicely as well, bringing them from negative to neutral in our scoring. The folks at Cass believe that we're beginning to see some restocking of inventories. They did say that while seasonality remains soft in the near term and there are no more extra days on the calendar, they had an extra day in February, which helped this as well. Underlying volumes seem to be showing some improvement. So that, to us, is a net positive in terms of what it says about the current state of the economy. Inflation, however, continues to be stubborn, and while the market did react particularly to PPI, it's interesting to me that the market has been holding up relatively well. I can tell you, folks, our observation is that the Fed has sent a strong signal that they will indeed be cutting interest rates this year, come hell or high water. Right now, as things look today, the notion of the 6 cuts that were discounted a few months ago obviously is completely off the table. Right now, we're looking at maybe 3 rate cuts this year. It looks like June is where the market expects that first rate cut to come. Raphael Bostic, however, he kind of intimated recently there may only be one. He said maybe we should just do one and then wait and see. Clearly and rightfully so, they're getting concerned about inflation. And here is last week's CPI print. You can see headline CPI ticked back up to 3.2 on a year-on-year basis. The month-on-month reading was up 0.4. So annualize that, and that's problematic relative to the Fed's goals. Take out food and energy, you got a little tick lower, but it's still way up there above their target. And on a monthly basis, way above their target as well. I mentioned producer prices. They definitely came in hot, 0.6% month on month, literally double what economists had estimated. So I was painting back in here, folks, you may recall, a bullish technical pattern for copper. We had your falling wedge pattern, and we had very strong bullish divergences. And sure enough, as you can see here, copper has seen quite the pop. We'll see how this continues. You can see we're breaking out above a level right here. That's bullish in terms of what it says about the economy, but it's also bullish, so to speak, in terms of what it says about inflation, and that's potentially problematic for a market that seems to be completely focused on what the Federal Reserve is going to be doing in the coming weeks and months. Baltic Dry Index captures the cost of shipping goods across the world's oceans and says something potentially positive about global activity, and we score it as such in our index, but it also says something about cost pressures throughout the world. And then to turn that completely on its head, the ratio of consumer staple stocks to consumer discretionary stocks in the U.S. continues to really bolt higher. So staple stocks, things that do better during recessionary periods or during economic slowdowns than discretionary stocks, is outperforming discretionary by 5.3% this year. And by the way, folks, staples is one of our top sector weightings here currently. To put that in perspective for you, let me jump back here to the late 90s. And you can see why we respect this indicator. Here, staples were ramping up leading into the early 2000s recession. Here they were ramping up and through the great financial crisis. Here they were ramping up back before the COVID recession. And here they were ramping up before 2023, where the whole world literally was anticipating, us included, recession. Our light was definitely lit and still is. And then I just showed you, what's going on here. So this is a red flag once again. And then in terms of our light being lit, I wanted to throw this illustration. This will look familiar to longtime viewers. I don't think I've thrown this up here in a while, but this is the score of our index at key points plotted against the S&P 500. So the white line is the S&P 500. These scores are the scores of our PWA index, which I highlighted for you at the intro. Minus 19 is where we are currently. So folks, you can see here that in August of 2019, the index rolled over when the market was at all-time highs, and we started hedging our portfolios with options, which was a beautiful thing, obviously, when the market gave up 35-40% over a very short period of time during the COVID lockdowns. Our view, though, was that a pretty significant deep recession was coming. That got entirely mitigated by trillions upon trillions of dollars of monetary and fiscal stimulus. And so this was anomalous, historically speaking. Typically, in a recession, you get your first leg, you get a half, 2/3 rebound, and then you roll back over. But we've never had anything remotely like the stimulus that was brought to bear. So our indicator turned green again back here, actually in January of 2021. And stayed there, but we stayed relatively cautious. Clients, you made money in here, but we did not jump back on the bandwagon or allocate to equities like we were the whole time through here, all through the 90s, even the 80s. I started in 84. But we were definitely rotating. I was selling tech with both fists here because we were just overweighted. And then we were buyers of tech back in here. We were big buyers of stock down in here. And we were holders all throughout this period because, as you can see, our indicators were suggesting that we were continuing to expand, and these were bull market conditions the whole time. So we lived through some pretty tough volatility at times, but we were rewarded for it. Here, we didn't have that luxury because you can see what the scoring was. But in here, just still trying to get our heads around all the stimulus and what it means and what the risk is. So thankfully in 2022, we captured less than half of that bear market. Not so much because of the hedging, because it wasn't a swift decline. It was really just because of our conservative posture or our moderate posture in terms of our portfolio allocation. And here we are signaling that recession risk is too high and we have to remain guarded and hedged against something, swift and meaningful to the downside. Now, if we go back and back test, you can see this is an unusually long period of time, right? You can see before the tech bubble burst, it was just a few months before the peak when our indicator said recession odds are high. Right here, just a few months before the Great Recession. And this would signal the need to be cautious if you're a long-term macro-oriented investor. Things turn green in here, but again, just historically unusual, to put it mildly, conditions. And folks, you may recall back up in here, we actually set a 3,500 price target on the S&P, and that's exactly where it hit. But we said if our recession light is lit, this isn't something that we're going to have high conviction is sustainable. We've done fine through here. This is a problematic look, folks. So for what that's worth, even though we had a cautious tone in here, we were in the expansion camp in terms of our assessment. We were just still cautious on equities, and we're very glad we were, at least for that stretch during 2022. And then, as promised, I want to just quickly update you on stocks. So folks, remember just last Thursday, we were in the higher end of this rising wedge pattern, and we closed just below it. That's a very concerning close on Friday. Still got these very compelling negative bearish divergences. But what I really wanted to show you is on the NASDAQ 100 ETF. Remember, I've been saying that this 20-day moving average has been very important support, and that if we break that, that could be problematic. We did break it here. It got saved with probably Fed commentary. Not sure what the earnings announcements were right in there, but came back. Haven't filled this gap just yet. But folks, we broke solidly below that moving average. And that is not a good look for next week. So right in here where we are is kind of a key level. We break below that, and I think you could see a swift move down here to the 50-day moving average, and we'll see what happens from there. Ultimately, folks, there's some real air under this market that would get filled with some lower levels. And as I showed you last week, sentiment is out over its skis as well. Now, there is a very legitimate bull case right here, and it's the kind of case that would have this next dip, if there's one to come, to get bought pretty significantly with both fists, and I don't disagree with it. In fact, I think it's very likely. So if we could get a high single digit to 10-15% correction, that'll be the green light, I think, for the Fed to start really supporting the market, both with language and with a Fed rate cut or three. I do think there is some political motivation, despite what they say this year. So I do think they are eager for an excuse to juice the economy and juice the markets. The problem right now is the stubborn inflation. In fact, the bottoming out and the turning back up of inflation potentially strains their credulity when it comes to cutting interest rates based on what they say they're there to do. So if the market gives them an opportunity, I think they'll take it. Our ultimate concern is that the recession odds that we think are still pretty high for second half of this year, first part of next year. But in the meantime, there's going to be some very interesting action in the market. So again, in summary, it would make sense to me that we get a pretty good dip over the coming weeks perhaps, and that inspires the Fed to take action, and then we get a pretty good pop out of that. What might actually make that happen would be next week's Fed meeting, where they maybe walk back some of this optimism about rate cutting, and if the market believes that the Fed may not be there to cut rates nearly as aggressively as the market is discounting, then I do think you get some serious selling, and then it creates that corrective action that has the Fed do a quick 180. So near term, I think we can maybe be a little more optimistic after a pretty good correction. Longer term, this cycle has more to play out, and there's too much of it that looks like it'll play out in a recession, and that is where you typically get your much more serious leg lower in equities that we need to remain hedged against. So folks, I will leave it there. Thank you as always for watching and listening, and I'll be back very soon. Take care. Bye-bye.